Everyone thinks Michael Burry became famous for predicting the 2008 crash, but that's only half the story. The real story, the one he almost never talks about, is why he stopped investing afterward, why he closed Scion Capital in 2008, even though he was right and everyone else was wrong. Most people think it was victory. In truth, it was retreat. Burry didn't close his fund because he lost faith in markets. He closed it because he understood them too well. He realized something deeper than housing bubbles or bad mortgages. He saw the machinery beneath them, the system that keeps creating bubbles, then disguising them as growth. And here's the paradox. The same warning that made him walk away once is flashing again right now. Back in the mid-2000s, the world believed in infinite leverage, cheap credit, housing that never goes down. Everyone from Wall Street to Washington said it was safe. They used the same words that every collapsing empire uses before the fall: stability, innovation, liquidity. In truth, they were printing illusions. Burry's spreadsheets were the only place in the world where the math didn't lie. He saw that the bonds built on American mortgages weren't backed by real payments. They were backed by hope. Hope that interest rates would stay low forever. Hope that debts could multiply faster than income. That's the moment he realized he wasn't looking at a financial market anymore. He was looking at a Ponzi scheme with a flag on it. When the crash came, he made hundreds of millions. But what he said afterward is what matters more. It's not over. The system didn't change. It just found a new disguise. And that's the warning that's back today. The same signals, distorted prices, artificial liquidity, and central banks engineering stability through debt, are blinking again. Except this time the bubble isn't in houses. It's in everything. Look closely and you'll see the same pattern repeating, not because of greed or stupidity, but because the numbers themselves demand it. Systems built on credit must expand or die. If that sounds familiar, it should. Every empire in history has learned the same lesson. When growth becomes mandatory, collapse becomes inevitable. To understand why Michael Burry closed his fund, you have to understand what he saw, not the housing market, but the machine behind it. Because the bubble that exploded in 2008 wasn't an accident. It was designed, not by villains in dark rooms, but by a system that was trying to postpone gravity. It began decades earlier, in 1971. When President Nixon closed the gold window, ending the convertibility of the dollar into gold, he didn't just change monetary policy. He changed the very definition of value. From that moment on, money was no longer tied to reality. It was tied to confidence. Governments could create dollars, banks could multiply them, and investors could treat promises as assets. The old world of limits, gold, production, savings, was replaced by a new world of leverage, derivatives, and debt. The system that emerged was elegant and deadly. The U.S. Federal Reserve became the ultimate dealer of trust, capable of expanding or shrinking the supply of credit with a single decision. Banks became intermediaries between reality and illusion. They could lend money that didn't yet exist to buy assets whose price would rise precisely because of that lending. It's a loop, a self-feeding illusion. Every dollar of debt creates an artificial demand for something, a house, a stock, a bond, which raises its price, which makes everyone believe they're richer, which encourages more borrowing. The mechanism is simple, but it has one fatal flaw. It needs constant expansion. Like an empire that collapses the moment it stops conquering, the credit system collapses the moment credit stops growing. By the early 2000s, this system had metastasized into a labyrinth of financial innovations: derivatives, collateralized debt obligations, mortgage-backed securities, all beautiful words for slicing and selling the same promise 1,000 times. Every piece of paper looked safe because it was rated by the same agencies that were paid to say it was safe. Everyone had a reason to believe, and no one had an incentive to check. This is the world Michael Burry stepped into with Scion Capital in 2000. A doctor by training, not a Wall Street insider, He looked at the data without the filters of faith, and what he saw was arithmetic, not narrative. Millions of mortgages with adjustable rates that would reset higher. Borrowers who could barely afford the teaser rate, let alone the real one. And banks repackaging this fragility into investment-grade products. It was the same structure that destroyed France in the 1790s with assignats, paper money printed against confiscated church land. At first, everyone believed it was wealth creation, until it wasn't. Then the same voices that called it innovation called it inevitable collapse. The pattern repeats because the mechanism repeats. Convert illiquid promises into liquid wealth until the math revolts. Burry understood that the mortgage market wasn't just a bubble, it was a symptom. The deeper disease was monetary moral hazard. Central banks had taught markets that risk would always be rescued. After every panic, 1987, 1998, 2001, the Fed had cut rates and injected liquidity. Like a doctor addicted to morphine, the system had lost the ability to feel pain. By 2003, the Federal Reserve's interest rate was just 1%. By 2005, real estate prices were rising at double digits per year. Wall Street turned that euphoria into products worth trillions. Pension funds in Norway, municipalities in Germany, banks in Japan, all were buying American safe assets whose safety depended on American borrowers never missing a payment. But Burry saw what they didn't, a trillion-dollar illusion built on subprime math. His short against the housing market was not just a trade, it was a statement. He was betting against the world's most powerful idea, that debt equals prosperity. What's remarkable is that he wasn't alone in warning. Economists like Nouriel Roubini, hedge fund managers like Paul Singer, they all saw parts of it. But Burry went further. He realized the crash wasn't the failure of capitalism. It was the success of fiat finance. The system was working exactly as designed. Create debt, inflate assets, socialize losses. That's why he closed his fund after the crash. He didn't believe the system could reform, because the same men who broke it were now in charge of fixing it, with the same tools: lower rates, bigger bailouts, more liquidity. The mechanism simply evolved. The mortgage bubble became a sovereign debt bubble, then a corporate debt bubble, then a market-wide bubble inflated by central bank balance sheets. If you strip away the complexity, the logic remains medieval. Paper replacing gold, trust replacing production, and a priesthood of bankers deciding the value of faith. And if you think that's ancient history, look again at your index fund, your mortgage rate, your government bond. The architecture Burry studied never disappeared, it just changed names. Because when a system learns it can print stability, it forgets what real stability feels like. If this helped you see how the mechanism was built, tell me where you're watching from. Once the machine was built, the illusion became self-sustaining. From roughly 2003 to 2007, it looked like America had discovered the philosopher's stone, turning paper promises into concrete wealth. But it wasn't wealth. It was leverage wearing a tuxedo. Everyone believed they were getting richer. Homeowners watched their property values rise month after month and felt brilliant. Banks congratulated themselves for risk management. Politicians bragged about record home ownership. Even the poor were told, "Your house is your ATM." It was a democracy of debt. Anyone could join the party. The mechanics of the illusion were simple. If a house price rises 10%, a homeowner feels richer and borrows more. That new borrowing becomes someone else's income, which fuels another price rise. It's a feedback loop that feels like progress. You could call it optimism, or you could call it alchemy with spreadsheets. Wall Street industrialized that optimism. Mortgage brokers got paid for volume, not quality. Rating agencies stamped AAA on toxic waste because it made their clients happy. Pension funds bought the waste because it yielded 6% instead of 4%. Everyone earned a fee at every step. Nobody had skin in the game except the last person holding the bond, and by then, the bond had been sliced, sold, and insured a dozen times. The financial system turned into a casino where the chips were houses and the credit lines were infinite, but the dealers were also the gamblers. JP Morgan, Goldman Sachs, Citigroup. The risk didn't disappear, it just kept being renamed. Every time the pile of promises grew too tall, Wall Street invented a new acronym to hold it. MBS, CDO, CDS. It looked scientific, mathematical. In truth, it was medieval. Faith backed by faith. And faith is powerful. Even central banks believed in it. When the Federal Reserve looked at the market, they didn't see danger, they saw financial innovation. When Alan Greenspan was asked whether derivatives could threaten the system, he said, "The market will self-regulate." That was 2004. 2 years later, subprime debt exceeded $1 trillion. Here's the paradox. The more dangerous the system became, the calmer it looked. Volatility fell to record lows. Credit spreads narrowed. Every metric designed to measure risk told investors there was none. It's the same pattern we saw before every great collapse, in the South Sea bubble of 1720, in the Roaring Twenties before 1929, and in Japan's stock real estate bubble of the 1980s. When everyone believes the system is stable, it's already broken. By 2006, television networks were running house-flipping shows. Taxi drivers discussed property portfolios. Banks offered 0% down mortgages, ninja loans, no income, no job, no assets. The illusion became culture. You weren't irresponsible for borrowing, you were building equity. If you questioned it, you were a pessimist, a relic, someone who didn't understand modern finance. Michael Burry understood perfectly. He watched as the derivatives built on bad mortgages were repackaged again and again, each time farther from the real world. He knew the data, millions of adjustable rate loans set to reset between 2007 and 2008. He didn't need prophecy, he needed arithmetic. But the system didn't want arithmetic, it wanted belief. Wall Street bet against him. Investors in his own fund rebelled. The market kept rising, and Burry's clients accused him of losing touch with reality. They didn't know that the reality they were defending was already an illusion. Every empire has its illusion phase. Rome had its cheap grain from Egypt, Britain had its colonial credit, America had its housing boom. The illusion phases feel like miracles because debt expands faster than consequences. You can double the paper, and for a while it feels like you doubled the wealth. But all you've really done is pull the future into the present, and like all illusions, it needs believers to survive. Banks need depositors, governments need taxpayers, markets need optimism. The moment doubt appears, the spell weakens. That's why the illusion phase always ends abruptly, not because the numbers stop working, but because people start noticing they don't. In 2006, that noticing began. A few mortgage lenders went bankrupt, a few hedge funds froze withdrawals. The news called them contained. But containment is the last lie before collapse. Still, in those years, the mood was intoxicating. America looked invincible. The dollar was supreme, credit was infinite, and risk management had replaced prudence. Like every empire before decline, the signals of doom looked like signs of progress. If you'd asked anyone in 2006 what could go wrong, they'd have said nothing. The market is self-correcting. And they'd have believed it, because illusions are most beautiful right before they break. If you recognize that pattern, illusion mistaken for progress, tell me in the comments, where are you watching from today? The first cracks always look small. A missed mortgage payment here, a failing lender there. In early 2007, a few subprime companies went under. New Century, Ameriquest. The headlines were cautious, isolated stress, temporary correction. But Burry knew better. He'd been counting the dominoes for years. Inside his spreadsheets, the illusion had already shattered. He could see the adjustable rate mortgages resetting month by month, hundreds of billions of dollars in loans moving from teaser rates of 2% to real rates of 8%. The math was brutal. A family earning $40,000 a year could no longer pay a $3,000 mortgage. The defaults began like a whisper, but the whisper spread faster than the models could handle. And then something strange happened. Prices fell, and everything broke at once. That's how leverage works. When prices rise, debt feels invisible. When prices fall, it becomes unbearable. The very instruments designed to spread risk ended up synchronizing it. CDOs, CDSs, tranches, all connected to the same dying pulse. The machine that was supposed to diversify danger instead transmitted it globally, like an electric shock through every major bank. By summer 2007, Bear Stearns collapsed. By March 2008, the Federal Reserve was bailing out investment banks. By September, Lehman Brothers, a 158-year-old institution, ceased to exist. That month alone, $14 trillion in global wealth evaporated. The free market had to be nationalized overnight. The government became the insurer, the buyer, and the undertaker. The paradox was complete. Capitalism had to be saved by socialism for the rich. When the crisis reached its peak, the U.S. Treasury printed $700 billion under the TARP program. The Federal Reserve injected trillions more through emergency lending facilities. And here's the twist. It worked. In the short term. The panic stopped, the stock market bottomed, the illusion restarted. But the cure was the disease. More debt to solve the debt crisis. Burry had already closed his fund by then. He had fought his battle, won his fortune, and walked away disgusted. In his final letter to investors, he wrote that markets no longer rewarded truth, only compliance. The math would always be secondary to narrative as long as central banks could create infinite liquidity. Look at what happened next. The Federal Reserve's balance sheet, which had been under $900 billion before the crash, exploded past $2 trillion. Interest rates dropped to near zero, and the message was clear. There would never again be a true correction. From now on, every problem would be met with more money. It was the same logic that destroyed the French assignat, the German mark in the 1920s, the Argentine peso in the 1980s. Each began as an emergency measure, temporary support, necessary stimulus. Each ended in moral hazard so deep that entire generations forgot what value meant. The mathematics of collapse are not mysterious. When the base of real income stops supporting the pyramid of credit, gravity does its work. In 2008, the pyramid cracked, but instead of rebuilding, we simply made the base wider, with sovereign debt, corporate bonds, and central bank money. The illusion was restored by decree. And yet, for a brief moment during that autumn, the truth was naked. You could see how the entire financial architecture depended on faith. Banks didn't know which assets were worthless because every asset was built on the same lie, that tomorrow would always pay for today. Burry wasn't the only one who saw it. In London, Iceland, Madrid, everywhere the credit tide receded, people realized they'd been living in a system where growth itself was borrowed. The same mechanism that once expanded opportunity now devoured it. That's why his warning wasn't about housing. It was about the principle. When debt becomes the engine, collapse isn't an accident. It's the end point. The crash of 2008 wasn't the end of the illusion. It was the rehearsal, because governments, banks, and investors all drew the same false conclusion. It worked. We prevented catastrophe. They didn't see that the catastrophe was only postponed. The virus survived, hidden in the cure. And now, years later, the warning light Burry saw is glowing again. Different form, same mathematics. Every new miracle market rests on the same promise, that the system can expand forever without consequence. Arithmetic disagrees. If you've ever watched belief turn to panic, optimism turn to numbers, right where you're watching from, the pattern never dies. It just waits for a new generation to call it progress. If the 2008 crash was the earthquake, what followed was the reconstruction of illusion. Central banks stepped in not as referees, but as architects. The Federal Reserve, the European Central Bank, the Bank of Japan, they all began a vast experiment, quantitative easing, a polite phrase for buying their own promises. They told the world it was temporary, that once the economy stabilized, the printing would stop. But it never did. The system had adapted. After 2008, global debt didn't shrink, it doubled. In 2007, total world debt was about $140 trillion. By 2025, It's over $300 trillion. The fire was never extinguished. It was fed with cheaper fuel. What used to be a housing bubble became an everything bubble. Stocks, bonds, real estate, even art, all inflated by the same mechanism: zero interest rates and infinite liquidity. Governments borrowed more, companies bought back their own shares, and investors stopped asking where profits came from, as long as prices went up. That's the modern echo of the warning Burry saw. The danger isn't bad loans anymore. It's the assumption that debt no longer matters. Every central banker now believes they can control the economy the way a pilot steers a plane. Gentle adjustments, smooth landings. But the truth is closer to physics than to aviation. You can't abolish gravity with confidence. Between 2009 and 2021, global markets experienced the longest bull run in history. The Dow tripled. Tech stocks turned into cults. Apple and Microsoft became wealthier than entire nations. But the base was the same as in 2006: credit and belief. When central banks printed trillions, it wasn't stimulus. It was a transfusion to a patient that couldn't breathe on its own. Then came 2020, a global pandemic, a perfect excuse for the largest monetary expansion in modern history. In a single year, the U.S. printed more dollars than in the first 2 centuries of its existence. Stimulus checks made citizens temporary speculators. Stock apps turned trading into a game. The line between monetary policy and mass psychology dissolved completely. And who benefited? The same structure that always does: those closest to the source of new money. Asset owners, banks, funds. The illusion of equality was replaced by a deeper inequality, one measured not in wages but in access to credit. For every dollar the public received, 1,000 went to financial markets. That's why the new crisis, when it comes, won't look like 2008. It won't start with mortgages. It'll start with government debt, corporate leverage, and a trust deficit. Burry himself has been warning again: massive short positions against the S&P and Treasury markets. He's not betting on chaos, he's betting on arithmetic. Because when interest rates rise after 15 years of zero, the mathematics turn vicious. Every dollar borrowed cheap must now be refinanced expensive. Governments that promised infinite spending suddenly face interest costs larger than defense budgets. Corporations that survived on debt face balance sheets that bleed at every tick higher. And yet the mood is the same as 2006: contained, manageable, under control. The same phrases, the same tone, the same blindness. Only the actors have changed. Central bankers play the role of divine engineers, promising soft landings while fueling asset bubbles that feed inflation. Investors convince themselves that this time is different. But history never changes its grammar, it only updates the vocabulary. In the 18th century, they printed assignats. In the 21st, they print bonds and digital credits. Different paper, same belief: that faith can replace value forever. Burry's original insight was never about predicting crises. It was about recognizing repetition. Every time money detaches from real production, it seeks safety in numbers. And every time, those numbers eventually return to reality. The warnings he saw in 2005, distorted prices, suppressed volatility, universal optimism, are visible again now, only magnified by scale and technology. The system didn't heal, it evolved into one that depends not just on cheap money, but on permanent illusion, the idea that we can borrow time itself. But time, like gold or trust, can't be printed. And when the arithmetic catches up, it doesn't negotiate. If you can see today's new normal for what it is, an old system wearing a new costume, right where you're watching from. Because every empire that thought it mastered debt learned the same lesson in the end. You can postpone the bill, but you can't erase it. Every financial crisis begins as arithmetic and ends as morality. It's never just about money. It's about truth. The numbers expose what the words were hiding. Michael Burry's real message was never the market will crash. It was that the system is addicted to forgetting. Each generation builds its own illusion of control, its own justifications, its own vocabulary for greed. In the 1920s, it was industrial expansion. In the 2000s, it was financial innovation. In the 2020s, it's monetary flexibility. Different words for the same ritual, worshiping growth while burying debt under hope. The reason Burry closed his fund wasn't fear, it was clarity. He had stared too long at the machine and realized it couldn't stop, because stopping meant admitting the lie. He understood that capitalism, when fused with central banking and politics, becomes something older, a belief system maintained by faith, not productivity. We are all inside that faith now. Every pension, every mortgage, every safe index fund depends on the same invisible assumption that credit will always expand faster than collapse. We tell ourselves that technology will save us, that policy will adjust, that this time the cycle will end gently. But cycles don't end gently. They exhaust themselves. And so the warning returns, not as prophecy, but as pattern. Whenever numbers grow faster than real goods, when promises multiply faster than trust, the reckoning isn't optional. You can shift it in time. You can rename it restructuring or quantitative easing, but you can't avoid it. Arithmetic waits. If you're hearing this in 2025, look around. Rising prices, swelling deficits, markets detached from wages. These are not signs of strength. They are echoes of every empire's last decade. And just like those before us, we'll call it progress until it breaks. The moral is simple and eternal. Systems don't collapse because of bad intentions. They collapse because mathematics outlasts illusion. If that idea makes sense to you, if you've ever felt the world running faster than its own balance sheet, leave a comment with where you're watching from, because the next correction won't be a crisis of finance. It'll be a crisis of memory.